Welcome to the deep dive. Ever find yourself looking at maybe a W-2 or some 1099s and just feeling, well, confused? You know, that feeling like you're lost in a maze, asking yourself, do I actually need to file taxes this year? And when exactly is that deadline? Trust me, you're definitely not alone there. So, our goal in this deep dive is basically to give you the map for that maze. We're going to break down who needs to file and when, pulling out the really key stuff from our sources, expect some clarity, maybe a few surprises, and definitely some practical tips to make tax time feel, well, less like a maze.
Okay, but before we get deeper into all that, just a quick reminder. This deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations we're discussing, it's all derived from the great accounting resources over at farhatlectures.com. So whether you're maybe an accounting student studying for the CPA exam or already a professional, you should definitely check out the website. They've got more practice questions, video lectures, tons of support. It's really good stuff to reinforce what we talk about today. And a big thanks to Professor Farhat for providing this material for us.
Absolutely. Okay, so let's start unpacking this first puzzle. Who really needs to file an individual tax return? You said it's not just about making money.
That's right. It's a bit more nuanced. For individuals, it mostly comes down to three main things the IRS looks at.
Three things. Okay, what are they?
First, your filing status. Are you single, married, filing jointly, separately, head of household? Yeah. Or maybe a surviving spouse. This matters a lot because your filing status determines your basic standard deduction amount. That's number one.
Okay, status. Got it.
Second is your gross income. And that means all your income from every source before you take out any deductions. This number gets compared directly against that standard deduction we just mentioned.
Income versus deduction. Makes sense. What's the third?
Age. Specifically, being 65 or older by the end of the tax year. That usually gets you an additional deduction amount on top of the standard one, which naturally affects the income level where you need to start filing.
So the basic idea is check your gross income against your standard deduction, plus any extra bit for being over 65.
Exactly. If your gross income is more than that total, you generally have to file a return. That's the core concept.
Okay, but you mentioned additional deductions. I thought there was also one for blindness. Does that fit in here too?
Ah, good question. That's a classic point that can trip people up. Yes, there is an additional standard deduction if you're legally blind, but, and this is the key distinction, that particular deduction for blindness does not change the calculation for whether you're required to file in the first place.
Oh, really? So you only factor in the age addition for the must-file calculation?
Precisely. The blindness deduction is something you claim if you have to file anyway
Right.
to lower your taxable income. It doesn't affect the initial filing threshold itself. It's a common trick question area on exams, actually.
Huh. That's really good to know. So being blind doesn't automatically mean you don't have to file if your income is over the regular limit.
Mm.
Okay. What about less standard situations, like, say, you're self-employed, a freelancer, or maybe claimed as a dependent on someone else's return? Do the rules change?
They do. These are really common scenarios. Let's take self-employed folks first. For them, it's not about gross income, but net earnings from self-employment. So that's your profit, basically your business income minus your expenses. If that net profit is over a certain amount, it's often around $400, but always check the current year's figure as it adjusts. Then you need to file, even if your total gross income wouldn't normally require it.
Only $400 in net profit. Wow, that's quite low.
It is surprisingly low for many, yes. Now, for dependents people, someone else claims their standard deduction is calculated differently. It's the greater of two amounts, either a base amount, let's say $1,100 for example's sake, or their earned income plus a smaller amount, maybe $350. But critically, that total deduction for a dependent can't be more than the regular standard deduction for a single person.
So they have their own special calculation.
Exactly. And because of that, a dependent might still need to file. Maybe they had taxes taken out of a summer job and want a refund, or maybe they have unearned income, like from investments, that pushes them over their specific dependent filing threshold.
Okay, this is making more sense. We've got the rules, the concepts. Can we put some actual numbers to this? I know the dollar amounts change each year with inflation and stuff, but seeing examples really helps make it stick. Let's maybe use, say, 2022 figures just to illustrate the rules.
Absolutely. Using 2022 numbers is a good way to see how the rules work. Remember, everyone, these specific numbers change, but the principles stay the same year to year. So for 2022, a single person under 65 generally had to file if their gross income was over $12,950.
Because that was the standard deduction for single that year.
Precisely. If your income was below that, The standard deduction would wipe out any potential tax liability anyway.
Okay. What if that single person was 65 or older?
Then you add the additional age amount. For 2022, that was $7,950 for singles. So $12,950 plus $7,750 makes the threshold $14,700.
Got it. And for married couples filing jointly?
For married filing jointly, MFJ, under 65, the threshold was $25,900 in 2022.
And if one spouse was 65 or older?
You add an additional amount, but slightly different for MFJ. It was $1,300 in 2022. So $25,900 plus $1,400.
And if both spouses were 65 plus?
Then they each get that extra $1,400. So you add $2,800 total to the $25,900 base.
Okay, that follows a pattern. Any filing statuses that are, like, really different?
Oh, definitely. The one that surprises everyone is married filing separately. If you choose that status, you have to file if your gross income is just $5.
$5? Seriously?
Seriously, $5. It's often seen as, well, a penalty status in many ways. The system generally encourages joint filing for married couples. Filing separately triggers that incredibly low $5 threshold.
Wow. Okay, mental note made. What about head of household?
For head of household in 2022, the threshold was $19,400.
And if they were 65 or older?
You add the single person's age addition, that's $7,750. So $19,400 plus $1,750 gives you $21,150.
Okay. Last one, surviving spouse.
Surviving spouse with a dependent child used the same base threshold as married filing jointly, so $25,900 for 2022.
And if they were 65 plus?
Same logic. Add the MFJ age addition of $1,400, making it $27,300. It mirrors the MFJ structure.
That's a great breakdown. Seeing the numbers really clarifies how the status and age interact with the standard deduction. But it does bring up a really important question. If your income is below these levels, meaning you technically don't have to file, why would anyone go through the hassle? It sounds like extra work for nothing.
That's a super common thought process, but it's often a mistake not to file. You're right, the requirement is based on gross income. But the biggest reason to file anyway is if you had any federal income tax withheld from your paychecks during the year.
Ah, like from your job.
Exactly. If you had tax taken out, but your total income ends up being less than your filing threshold, filing a return is the only way to get that withheld money back as a refund.
So it's your money, basically, that the IRS is holding.
Precisely. You have to file to claim it. And beyond just refunds from withholding, there are refundable tax credits. Things like the Earned Income Tax Credit or parts of the Child Tax Credit. These can give you money back even if you didn't owe any tax or have any tax withheld. But again, you must file to claim them.
Okay, refunds and credits. Any other reasons?
Yeah, one more big one, kind of administrative. Filing gets you officially on the books with the IRS for that year. If there are ever future government benefits, stimulus payments, things like that, which are based on tax filings, well, if you didn't file, you might not exist in their system for that year, and you could miss out.
So even if you don't technically have to, it's usually a really good idea to file anyway.
Almost always, yes. It protects your ability to get refunds, claim credits, and be recognized for potential future benefits. Don't leave money on the table or make yourself invisible.
Great advice. Okay, we've thoroughly mapped out the who. Let's move to the second big question. When do you need to file? I think everyone knows April 15th, right? That date seems burned into our collective consciousness. But is it always April 15th?
April 15th is the standard deadline for most individuals, yes. Technically, it's the 15th day of the fourth month after the end of the calendar year, since most people use a December 31st year end.
4 months later is April 15th.
Exactly. But here's the key detail. If April 15th falls on a Saturday, a Sunday, or a legal holiday,
The deadline shifts.
it shifts automatically to the next business day. So if the 15th is a Saturday, the deadline becomes Monday the 17th. If the 15th is a Sunday, same thing, it's Monday the 16th.
Okay, so watch the calendar, not just the date.
Definitely. And sometimes a local holiday in Washington, D.C., like Emancipation Day, can fall around then and push the national deadline back a day or two as well. Always check the official IRS date for the year.
Good tip. Now, what about businesses? Do corporations and partnerships follow that same April 15th individual timeline?
No, they often have different deadlines, and it depends heavily on the type of business entity. Let's start with C corporations. C Corp have to file a return every year, regardless of whether they made a profit or loss. Their standard due date is generally the same as individuals, the 15th day of the fourth month after their fiscal year ends.
So if their year ends December the 1st, it's April 15th.
Correct. But there's a weird exception. C Corp that have a fiscal year ending on June 30th, their deadline is actually September 15th.
September 15th. That's the third month after June 30th, not the 4th.
Exactly. It's an odd historical quirk for just that specific year-end. A little trap for the unwary.
Huh. Okay, so C Corp mostly April 15th, unless they have that June 30th year end. What about partnerships and S Corp?
Ah, partnerships and S corporations are different because they are pass-through entities.
Right, you mentioned that they don't pay the tax themselves.
Correct. The income, losses, deductions, credits, they all flow through to the individual partners or shareholders' personal tax returns. Because of this structure, their filing deadline is actually earlier. It's March 15th, or the 15th day of the third month after their year ends.
March 15th. Why do they have to file a month earlier than individuals?
It's actually designed to help the individual owners. The partnership, or S Corp, needs to file by March 15th so it can figure out each owner's share of everything. Then, they prepare and send out the tax forms, usually a Schedule K-1 to each owner.
Ah, so the owners get their K-1s after March 15th?
Ideally, yes. This gives the individual partner or shareholder that crucial month, from March 15th to April 15th, to take the information from the K-1 and correctly report it on their own personal 1040 tax return before their deadline.
That makes perfect sense now. The March 15th deadline for the business feeds into the April 15th deadline for the owner. It's sequential.
Exactly. It's all about information flow.
Okay, this is great. We know who files, we know when. But life happens. What if you just can't get everything together by March 15th or April 15th?
Yeah.
Is getting an extension an option?
Yes, absolutely. Filing for an extension is very common. For individuals, partnerships, and S Corp, you typically file Form 4868. And the good news is, these extensions are usually granted automatically by the IRS as long as the form is filed properly by the original due date.
Automatic, so you don't need a specific reason.
Generally, no. You just file a form, and you get an automatic 6-month extension of time to file your return. So for individuals, that pushes the filing deadline to October 15th.
October 15th, okay. And C corporations.
They also get automatic extensions, usually 6 or sometimes even 7 months, depending on their year end. They use a different form, Form 7004.
So extensions are pretty straightforward to get.
Getting the extension is straightforward. But here comes the single most important point about extensions, probably the biggest misunderstanding we see.
Okay, lay it on us. What's the catch?
An extension grants you more time to file your paperwork. It does not grant you more time to pay any tax you owe.
Ah. So even if I get the extension and don't file until October?
You still have to estimate your total tax liability for the year and pay any amount you expect to owe by the original deadline, April 15th, for most individuals.
So you have to pay by April 15th, even if you haven't finished the return.
Precisely. If you file an extension but don't pay what you owe by April 15th, you'll face interest and penalties on the unpaid amount, starting right from April 15th, even though you have until October to file the forms.
That's huge. I bet a lot of people get caught by that. They think the extension covers payment too.
It's an incredibly common and potentially costly mistake.
Yeah.
The IRS wants its money on time, period. The extension is just for the paperwork submission.
Okay, message received. Extension is for filing, not for paying. Pay by the original due date. Wow. Okay. We have navigated quite a bit today, haven't we? From figuring out who needs to file based on, status, income, age, to understanding the different deadlines for individuals versus C Corp versus pass-throughs like S Corp and partnerships, and finishing with that absolutely critical point about tax extensions only covering the filing, not the payment. We've definitely dug deep.
We really have. I think the core things to remember are, for individuals, it's that comparison of gross income to your standard deduction plus age additions. That drives the must-file decision. And for businesses, the entity type is key for the deadline, March 15th for pass-throughs, generally April 15th for C Corp. And crucially, as we discuss, even if you don't technically have to file based on income, it's almost always smart to do it anyway for refunds, credits, and just staying on the IRS's radar. Be proactive.
So what does this all mean for you listening? Well, hopefully it means you feel a lot more confident navigating these tax rules. You've got that foundational knowledge now.
Yeah, and maybe this raises a good question to ponder. Knowing all this, especially about why filing can be beneficial even when not required, or about that payment deadline with extensions, how might you think about your own financial planning or record keeping differently next year? Could you make tax season smoother, maybe even uncover some benefits you weren't aware of?
Definitely some food for thought there. And if you want to explore these topics even further, remember this whole deep dive was powered by the excellent resources over at farhatlectures.com. It's a great place for more practice, detailed videos, and support on all things accounting and tax. Definitely check them out. Until next time, keep digging for those insights.